You're listening to Mr. Open Banking, the only podcast dedicated to exploring the open banking movement. Whether you're a financial expert, banking executive, or everyday consumer, open banking affects everyone and will change the way we interact with our money. I'm Eyal, your host. This episode is brought to you by Ozone API, unlocking the power of open finance all over the world. In the wake of the 2008 global financial crisis, when the world stood on the precipice of economic collapse, the demand for a better financial system became the nurturing bed for the seeds of change. It was then that the concept of open banking took root, a resilient shoot sprouting from the wreckage, promising innovation and renewal in the banking sector. At least, that's what happened in most places. As countries began adopting open banking regulations in response to the crisis, they often pointed to the United States as a laggard for not having any regulation of its own. In actual fact, the story of open banking in America goes back much further. Yodlee, one of the first financial data aggregators, was founded in the US in 1999, almost a full decade before the 2008 financial crisis. Even back then, Americans had begun sharing their financial data between banks and fintechs by whatever means available. They didn't need a crisis. They already had curious, tech-savvy consumers hungry for new ways to manage their money in the digital age. Since then, America has continued to take a staunchly market-driven approach to open banking. Players like Plaid and MX, Stripe and Square have grown into multi-billion-dollar companies. The Financial Data Exchange, stewards of the dominant open banking standard in the US, is a private nonprofit run by its members. But all that is about to change. The US has now begun their own journey towards regulated open banking, and our guest has a front row seat. John Pitts is the global head of policy at Plaid, perhaps the most well-known financial data aggregator in the entire world. Plaid's technology enables more than 100 million consumers to link their financial accounts with over 8,000 apps across 17 countries. In his role as global head of policy, John passionately advocates for the consumer's right to access, share, and control their financial data. He has consulted on consumer protection laws in the United States, Canada, the UK, the European Union, and Australia. Before joining Plaid, John served as the Deputy Assistant Director for Intergovernmental Affairs at the Consumer Financial Protection Bureau, or CFPB. At the Bureau, John worked to promote cooperation and coordination in enforcing the Consumer Financial Protection Act, also known as Dodd-Frank. He is a regular speaker on topics including student lending, payday loans, and the regulatory landscape, as well as emerging technologies such as cryptocurrency, regtech, and open banking. John, thank you for joining us.
Thank you so much for having me.
Let's open by setting some context. When you talk about open banking in the US, you often refer to what's happening today as a new era of open banking. What was the old era, and what do you mean by the new era?
When I say the new era, the old era was a consumer-driven era of open finance. That is, consumers really demanded access to products and services that the incumbent financial institutions either wouldn't or couldn't provide for them. This is where ambitious people were coming up with great new products to delight consumers and make their financial lives better. That era lasted around 10 years in the United States and actually has made the United States the biggest open banking market in the entire world, by some measures bigger than all open banking markets in every other part of the world combined. What's happening now is that the CFPB, Consumer Financial Protection Bureau, is bringing in regulation to solidify and expand that market. So in the past, data access was really just a completely commercially driven thing. Consumers would want to sign up for an app. They would use their log-on credentials to access that data and share it with the app they wanted to use. In other markets, that was really something where there was no consumer behavior around it. There was a desire to open up banking and open up financial services. And so regulation came first with the idea that the market would come behind it. The US has been consumer first, and now that market, which is a thriving and robust consumer market, is about to become a regulated market. And that has some huge implications for everyone.
So the old era in the US, you would still call that open banking, even though there was no common standard and there was no regulation?
I would. When someone says open banking to me, it is not regulation that defines open banking. It is what a consumer can do. Can any consumer at any financial institution take any piece of their financial data and share it with whoever they want in exchange for getting a product or service that makes their life better? That is open banking. Regulation is something that can either facilitate or prohibit open banking, but the regulation itself isn't open banking. The benefits to consumers are open banking.
Which means that those who may have classified the US as a laggard, you would not agree with that?
I would violently disagree with that. I think that is a fundamental mistake in understanding what open banking is and what it promises to people and to markets. The core promise of open banking is more choice and better choices for consumers. You don't need to get there through regulation. And in fact, some markets that have started with regulation have gotten it wrong in ways that have limited the value for consumers. When you view the consumer value as the center of what you mean by open banking, you're much more likely to say, what is it that I need to do to protect that consumer's ability to make those choices that they want and to give them more of them? That's why open banking, from a regulatory perspective, is now happening in the US. There was a pretty clear understanding from the regulator, the CFPB, that the market had gotten things about as far as it could on its own and had gotten to the point where conflicting interests had become irreconcilable in some instances because it was getting into areas of, this puts my business at risk of more competition if I allow this, and so I don't want to allow this. That's really where the CFPB has stepped in to break some of the disagreement on those questions in favor of more consumer access, more consumer sharing, more consumer choice, more competition, and really secure the next phase of growth in the market by having clear rules of the road for everyone that put that consumer choice and consumer benefit at the center of the equation.
Let's talk about how the US got there. You can speak to the perspective of the CFPB with some authority. Prior to joining Plaid in late 2018, you spent many years there on the regulatory side. During that time, regulated open banking was coming into its own all around the world. And in that respect, the US was being painted as a laggard. What was the perception of open banking at the CFPB back then, and how did you see it change over the years?
I actually want to answer this a little bit personally and talking a little bit about why I went to the CFPB in the first place. This is such a personal story for me and such a personal mission. So I joined the CFPB right after the 2008 financial crisis. I was on the early team there building out this new agency. And one of the things that was really obvious to all of us as we built it was that there had been some fundamental failures in the financial services market. And the one that always rang truest for me was the conflicting mission at prudential regulators between the safety and soundness of the organizations they regulate and consumer protection. The reason those missions can sometimes conflict is one of the things that makes an institution safe and sound is its profits and its revenue. And if you look at a product like, for example, overdraft fees, there are some financial institutions in this country where 100% of their profits come from overdraft fees. They would not be a profitable institution or bank without overdraft. That can create a perverse incentive both for the bank and for its regulator. If you say that overdraft is harmful to consumers, that results in you having to reduce the amount of overdraft fees you get, and as a result, reduce your profit. What was incredible about the creation of the CFPB is that it only had one mission, which was to protect consumers. That was a sea change in how the government thought about regulating financial services and making sure consumers were safe. And it came with a second sea change, which was that this consumer is the one who's meant to benefit from financial services, and they need to be the center of that. Section 1033, which is the open banking part of the Dodd-Frank Act, was really the section of the statute that drove that home. And so when I went to the CFPB, I went because I wanted to be at a place where, as we tried to build a better financial services ecosystem out of the detritus of the financial crisis, it was going to be the place that built it with the consumer in the center and thought about it that way, and thought about how do you solve some of the problems that became evident in the financial crisis. Consumers not understanding the products or services they were being offered, not having details on their mortgages, not having information on their accounts, and fundamentally not having a lot of choices in what type of financial services they used, and therefore sometimes being stuck in a debt trap. One thing as I worked on it more and more that I saw was that all of these products and service, all of this digitization of financial services depended on one thing. And that one thing was consumers being able to access and share their financial information and make it portable so that they could take it with them to go get another service. That really was something that a lot of folks at the CFPB and I personally saw as a deep and profound change in how financial services could work and how it worked for the consumer.
A question that often arises in open banking circles is whether it is better to be market-driven or regulatory-led. This question is a red herring. The answer is that for open banking to be successful, you need both. As John explains, a strictly regulatory approach often misses the mark on consumer benefit. On the other hand, an approach driven only by the market eventually leads to conflicts of interest. Now that the US has learned that lesson, they have begun to move quickly. On October 19, 2023, the CFPB released their proposed rulemaking for personal financial data rights. by leveraging the storied Section 1033 of Dodd-Frank. I asked John to give us an overview of what the proposed rulemaking actually says and its relationship to Section 1033.
The proposal from the CFPB is incredibly strong and in some ways is exactly the right foundation that you want to take open banking to the next level in this country. Let me just start with the foundations of what everyone needs to know. So, one, the proposal will shift over time the entire data access market from screen scraping to APIs. That's a transition that Plaid has been championing for years. Screen scraping is necessary when there's no other way for a consumer to get access to their data, but it's not the ideal way for data access to work. APIs are better on every metric from performance to privacy to security. It just requires the data provider, in many cases banks, but not in all cases, to actually build out that API. Two, it guarantees consumers access to their data and third parties access to that data with the consumer's permission. And here's where I want to be precise, because the transition to APIs, there's a version of that world where each individual data provider becomes the decision maker of who gets access to the data, what data is shared on it. And you can see a lot of opportunity there for a data provider to make choices that are not always 100% in the consumer's interest. It might be, oh, I am happy to share this data unless it is with a competitor of mine. I can point you to real world examples of institutions saying, we offer a PFM app, so we are happy to share consumer data with any app that is not a PFM app because we want our customers to just use our app. We don't think they should use anyone else's. Or we will share any data that our customer wants us to share unless it is interest rate on credit cards because we have high interest credit cards and we don't want to lose our customers to lower interest competitors. For obvious reasons, that's not going to be okay. That's not how open banking can work. And so making it clear that ultimately the consumer gets to decide what data they're sharing, for what purposes, with whom, really secures the digital financial services market for everyone. The last thing that I would point to in terms of great improvements in the market that will be driven by this is reciprocity. So one of these sort of old stories that you've probably heard people talk about with open banking is this is just about fintechs getting data and banks paying the cost of it. And there are some cases where that's true. The UK, frankly, the coiners of the term open banking, that is a competition order initiating open banking. It applies to the 9 largest banks in the country. They were required to build APIs and share data with fintechs, and they have no right to get any data themselves. The CFPB has done something much smarter than that. They've said that digital wallets are also a data source for the purpose of this regulation. So the popular apps where consumers can store funds are going to be covered by this. Banks will have just as much right to access data from fintechs as fintechs will have to access data from banks. And that is going to create what you really want, which is a balanced market where wherever a consumer has their financial data, they're able to access it and share it with someone else. So those are the goods. Let me give you 2 negatives, and then I want to talk about a very interesting sort of neutral that is positive, but I think a lot of folks are going to need to struggle and put some work in to make it positive. So the negatives are the CFPB went a little narrower than I think it should have. Critical accounts like mortgage, auto loans, student loans are not covered by this rule. Consumers don't have the right to access that data, and data providers don't have to build APIs to make that data available. The good news is that the CFPB has signaled that they intend to do follow-on rulemakings to require that data to become available. But it would be better if the CFPB was pushing more ambitiously for a broader consumer data access right from the get-go. The other thing that I think the CFPB rule falls a little bit short on is some of the restrictions on how data can be used to help consumers. Companies that use consumer data can't use that data to improve the products or services they're offering the consumer. That's a pretty basic business practice to say, oh, I can see that this product is working well, but based on how my consumers are using it, I can make it better. I can improve it for them. Using that data to improve products is something that the CFPB looks like they are limiting in this rule. There was a lot of industry feedback on that point. I do hope they take that seriously because it might limit some of the consumer value that gets delivered. Finally, I want to touch on the neutral and complex thing, which is there are new compliance obligations for everyone. I think that's great. If you are going to be handling consumer financial data, you need to do that with the responsibility and trust that comes with having access to what most consumers will consider their most important and confidential information. That said, adjusting to a world of compliance is a real adjustment for a lot of companies. With reciprocity, with everyone being both a data provider and a data recipient, which is where I think this market is going, we really need to balance both sides of the market and serve both sides.
Although there is an element of reciprocity in the proposed rule, it falls short of the true explicit reciprocity that exists in regulations in Brazil and budding regulations in Canada. Is that something you expect to happen soon? And is that the right read of the proposed regulation, that it's limited to digital wallets as opposed to saying everyone who consumes data must also share data?
It is the right read of the rule, unfortunately, is that it is just digital wallets. They're very explicit on that. I want to contrast that with Canada. The Canadian open banking proposal very directly states anyone who is receiving data must make data available as a precondition of participating. That's absolutely the right answer. So I applaud what Canada is doing there. I know that there are limits on what the CFPB could do here, and I think digital wallets is a great start. But I do think the more urgency there is for making this the first start of a snowball rolling downhill, as opposed to the last gasp as you run through the tape on a 100-meter sprint, will be critical in delivering the full value of open banking and ultimately open finance to American consumers.
You mentioned Canada, so let's go there. Regulated open banking is not only getting started in the US, it's happening in Canada as well. Although they seem to be moving in tandem, they are unfolding a little differently. You mentioned reciprocity. What are you seeing in the US versus Canada from a regulatory perspective?
I think licensure is a key thing that Canada is doing that will make things easier. So they are going to require that everyone in the market get a license. It includes the clarity of who is responsible for making the consumer whole if something goes wrong, and the limits, frankly, of where someone's liability may extend and where someone else's liability begins. One of the big complexities in making open banking work practically is we come from a philosophical background to financial services that permeates the United States, Canada, and many other markets that views the bank and only the bank as the critical mediator between the government and the consumer when it comes to financial services. What that means in practice is that regulators tell banks, we expect you to do this. We expect you to make everyone else you work with do this. You are effectively the extension of the government in terms of making sure all of this works. That has been really helpful in a lot of instances. It also means that there's no sort of edge to that regulatory perimeter in a lot of people's minds. The bank might be responsible for and accountable for everything. An open banking world, that can't be true. The consumer gets to pick who they want to do business with. They get to pick where they want to share their data. And the government is responsible for expanding its oversight to make sure they are protecting the consumer wherever the consumer decides to do business, not just the bank. And so licensure really helps solve that problem. I think there are going to be some big implementation questions that the CFPB can't fully answer with its open banking rule and can address through licensure because they don't have the ability to issue licenses or charters. And those questions are going to be about how risk management works in a world where multiple parties will have to work with each other to protect consumers in a more open system.
Your role is in fact a global role, and Plaid operates in 17 countries. What is your perception of open banking beyond North America?
First, let me give you the top line answer to that question, which is it is inevitable globally. I was at a meeting with a bunch of bankers recently, and I asked for a show of hands, how many people went into a shopping mall in the last month? I would say about 5% of the hands went up. How many people went on Amazon today? 80% of the hands went up. The reason I use that example is this is fundamentally about the technology of the internet coming to financial services. That's not something that is limited country by country. It is something that will happen everywhere. We are in the first inning of open banking as a global phenomenon. So, top line, it's inevitable and it's going to be global, truly global everywhere. And some countries are really embracing it and doing an incredible job. You mentioned Brazil earlier. Pix has been online in Brazil. Everyone I talk to thinks that it is one of the best deliveries of the open banking promise they've seen. And Brazil has done a phenomenal job of implementing it, such a good job that it may be one of the first true open banking exports from one country to another, as other countries look to adopt not just the framework of Pix, but Pix itself. Right now, I would put Brazil near the top in the effective delivery of open banking. Australia has the most ambitious framework, but I think they are struggling with some of the implementation. The US is still the biggest open banking market by far, and I think is going to experience a spurt of even greater growth once 1033 is finalized. And Canada might, at the end of the day, have the best regulatory framework, at least so far, partly because they've been able to watch what happened in other countries and use it to fine-tune their own approach based on lessons learned in other markets.
Let's talk standards. In the US, the FDX API from the Financial Data Exchange has clearly emerged as the leader. One of the things that makes FDX unique is its origins as a staunchly member-driven, market-driven standard. However, it's clear that you're very passionate about regulation and its importance relative to open banking. Why is the topic of regulation so important? And do you think that ultimately FDX needed some regulation to take it to the next level?
I cannot emphasize enough how much I care about regulation. I believe in regulation because it does some things extremely well. I also believe in markets because they do some things extremely well. And what I fundamentally believe in is checks and balances. The best outcomes usually happen not when one entity designs everything from on high, but when multiple bodies serving different interests with different perspectives come together in healthy tension with each other to try and come up with not what any one best solution is, but what the best solution is once all of those ideas are mixed with each other and the good ideas rise to the top and the bad ideas fall to the wayside. So I absolutely think that FTX needs the CFPB regulation to be successful. At the end of the day, a private body can come up with the best technology for data sharing, but it probably can't resolve the disputes of what data should be shared or on what terms. What the CFPB can do is say, this is the data that needs to be available. These are the rights the consumers have. These are the protections that consumers deserve. It can do that really well. What it can't do all that well is be nimble and reactive to the development of technology and what best delivers on those rights. And so you need that sharing of responsibilities. You need that tension in order to get to the best outcome for a market and for consumers.
Make no mistake, U.S. open banking regulation is on its way. Not because the market needs to be more competitive and innovative, but because consumers need protection in a market that is already competitive and innovative. The proposed Personal Financial Data Rights Rule aims to make sharing your financial data easy, safe, and, most importantly, as valuable as possible to you, its owner. American consumers will finally have not only more choice, but also more protection. Once the legislation is in place and the standard is established, things are going to change for everyone involved, whether fintechs, banks, or consumers themselves. I asked John what he thinks is going to happen next.
So I think the first thing that's going to happen is that the distinction between a data provider and a data recipient is going to effectively be erased. And I think in some key ways, that's also going to erase a lot of the differences between banks and fintechs. There will still be some things that only a bank can do. For example, taking deposits, accessing the Fed discount window, exciting things for bank nerds like me that only banks can do. But from a products for consumers perspective, consumers have voted with their thumbs, and they have voted in the direction of their financial services being at their control, with them at the center of it, using multiple services for different needs, and being able to do it on their phone. I'll tell you, one of the greatest experiences of my life has been changing the way I pay my kids' allowance. I used to hand them stacks of dollar bills on every Friday. That was a real pain. I had to go into a branch, get stacks of bills, hand them out, make change for my kids. I now have an app that does that for me and also lets my kids donate money to nonprofits and invest in the stock market and save for their future. And it just auto deducts every Friday from my account. It's the single greatest thing that's ever happened in my life, even though it's small. That's the type of digitization that's going to happen, and it's going to happen everywhere. There are going to be a lot of winners, and not the winners you would necessarily think. I think banks are a huge net winner from open banking, and in two different flavors. I think there are some small community banks and credit unions who, because they can connect their consumers and their customers with fintech apps, they don't need to have the $10 billion digital strategy funds that the big Wall Street banks have. They don't need to build every one of those products in-house, but their customers will still be able to access them by using their bank, meaning they don't have to leave to do business with a Chase or a Wells Fargo or a Bank of America. They can stay with their local bank and still get access to all the services they want. The second big winner, I think, is going to be companies that really embrace this digital future, that view themselves as the hub of their customers' financial life, not just from a dollars and cents perspective, but from a data perspective. One of the things that we have seen as consumers have started to connect their accounts is consumers usually have multiple bank and fintech accounts, but they pick one as the one they link all of their apps to. And over time, that account gets more and more use, and the accounts that are not connected get less use. That's because the consumer now views that account not just as a bank account, but as a platform for their entire digital financial life. It's a really different mindset to think about in terms of how you engage with your customer. It's not one where you are giving them every service, but you are giving them access to every service.
Much of that digital future already exists today, built by big tech. Where do they fit into the picture? What do data rights look like when applied to the Apples and Googles of the world?
I think one of the things that's exciting to me personally about open banking is it's an opportunity to have a different value proposition between consumers and their data than we've seen evolve in big tech. So I've said a couple of times during this conversation that this is basically the idea of the internet coming for financial services. One of the risks in that is there are a lot of internet experiences where consumers are not in control of their data, where actually the fundamental deal is we will give you a free service. In exchange for that free service, we are going to capture a lot of data about you, and we are going to sell that data to advertisers. We are going to turn you into a product. There's a different value proposition with open banking. That value proposition is you, the consumer, are in charge of your data. Are you willing to share this data in exchange for a service that is directly tied to that data that makes your life better? I think that's a fairer deal for consumers. Now, I don't think that is going to change the way that big tech works, but I do think that to the extent that big tech companies want to move into financial services, there are a couple of things they're going to need to get right. Getting compliance right is critical to being in financial services. It is not a move fast and break things industry. It is a do right by the consumer and build trust industry. And second, when it comes to open banking, it is fundamentally the consumer's data. You don't get to build any walled gardens. You don't get to monetize their data and turn them into a product for advertisers. I think those are important lessons for anyone operating in this space to deeply understand. And I think it's something where big tech can be a really critical player in financial services and deliver some real value to consumers as long as they deliver it on the terms of financial services rather than on the terms of some of the big tech practices that have grown up over the past years that consumers are increasingly uncomfortable with and unwilling to see move into their financial lives.
Do you think big tech will fight the trend towards openness or ultimately become part of it?
I think ultimately everyone, both big tech and big finance and small tech, needs to go to where the consumer is, where their customer is. And I am absolutely sure that what the customer wants is openness and interoperability and the ability to control where their data is and what services they are getting.
Many people, including myself, describe open banking as a stepping stone towards open data. But you've suggested that those who argue that it's only a stepping stone are missing how big open banking really is. What do you mean by that?
Financial services is ultimately a data business. That information has been controlled by the financial institution. It is part of their secret sauce. They are the exclusive holder of that information. Open banking fundamentally changes that dynamic by saying it's the consumer's information. They can take it from institution A and share it with institution B. That's a profound change. It's one that I think is fundamentally going to reshape how financial services work, the relationship between the consumer and their financial service provider, and the entire economics of how we think about banking and financial services. I don't think that needs to lead to anything bigger than that. It does not need to lead to your insurance data being available or your telco data. I think all of those things will be great if and when they happen. But I think fundamentally reshaping the core structure of how data works in financial services is a change that we are not going to see again in our lifetimes, and is one that is going to impact the lives of billions of consumers for the better in those lifetimes. That is more than enough for me.
Change how we interact with our money and change everything else.
You do interact with your money more than you interact with virtually anything else over the course of any given day in your life. It is one of the fundamental tools to existence for every human being on the planet, and open banking gives you more control than anyone has ever had over their money and their data, ever.
Where can our guests find out more about you and the work you're doing with Plaid, FTX, and everyone else?
The easiest place is to follow me on Twitter. I am @PolicyPits. You can also check up the Plaid blog. We post fairly regularly. We've actually just recently posted an article on how to get ready for open banking compliance under 1033. That's a great read for any company that wants to know what they need to be ready to do.
John, thank you for a wonderful conversation. It's been great.
Thank you so much. Wonderful to be on.
In the digital age, our personal data is the currency of power. A treasure trove, coveted by giants and wielded by a select few. Without control over this data, we are but pawns in a game of profit and manipulation. Of all the data in our lives, our financial data is likely the most important of all. It reflects how we live, how we engage with each other, how we dream of a better tomorrow. In a very real way, our data even includes the currency itself. It should come as no surprise that our financial data is where the buck stops. The deal we have made with big tech, where we allow our personal data to be traded and sold, is no longer tenable. It may be fine for tweets and posts and likes, but not when it comes to our money. The U.S. Consumer Financial Protection Bureau is working on a new deal. One that starts by giving Americans the right to control their financial data. to decide for themselves how it is used, by whom, and for what purpose. In John's words, giving them more control than anyone has ever had over their money, ever. But this is not just a quest for control. It is a quest for that most American of ideals: freedom. For in the realm of data, personal control is the key to a brighter, more equitable world in the US and beyond. Thanks for listening to Mr. Open Banking, the podcast that explores the ongoing evolution of open banking and its impact on our lives. Make no mistake, the rise of open banking is going to change financial services forever, and we will be covering that story every step of the way. This is your host, Eyal. Until next time. This episode of Mr. Open Banking was made possible by Ozone API, providers of the only API platform that supports every open banking standard in the world, unlocking the power of open finance. To learn more, visit ozoneapi.com.